Ladies and gentlemen, if you think today's headline is just silver touching a new high, you're staring at the smoke while the house is already on fire. What I am about to lay out is a chain reaction that starts quietly in vault reports and procurement contracts, then suddenly shows up as factory delays and prices that don't ask permission. Before we dive in, hit subscribe and drop John AG in the comments so the algorithm knows you're with us. Also, join the WhatsApp channel in the description for daily updates and analysis. I don't always share on YouTube. This isn't just about investors. It's about industrial users, supply chains, and a strategic material that modern civilization burns through every day. When something is essential, hard to substitute, and suddenly hard to source, prices don't drift higher. They snap. Stop thinking about silver like a trade and start thinking about it like a bottleneck. Silver is used everywhere in small amounts, a smear in solar paste, a thin contact in electronics. But when you add up a little here across billions of devices and millions of vehicles, you get a structural problem. The myth is that if price goes up, supply will show up. But that depends on time, permits, capex, skilled labor, and refining capacity. For years, the global market has pulled from above ground inventories to cover shortages. That works until inventories are drained. Once you drain the buffer, every small shock becomes a big shock. The United States used to maintain strategic stockpiles, not as investment, but as insurance. Then complacency hit. Strategic reserves collapsed by roughly 73% from historical peaks. When you liquidate strategic metal during low prices, you don't just sell metal. You sell resilience. You sell time. And time is the one thing you can't buy back during a shortage. The consequence? The US is now far more dependent on external flows. And when refining becomes concentrated, the controlling country gains leverage through licensing, domestic prioritization, and export friction. Spring isn't magical. It's when procurement cycles collide with visibility. Contracts get negotiated, production schedules get finalized. If a company cannot secure silver at predictable terms, they'll pay anything compared to the cost of stopping a multi-billion-dollar operation. Here's the key. Even big price jumps don't translate into huge percentages of final product cost. A manufacturer can tolerate much higher silver prices before it destroys demand. So if price needs to rise to ration demand, it may need to rise a lot. There's a difference between metal in storage and metal available for delivery. In tight periods, deliverable inventory drains fast. Recent reports show over 33 million ounces pulled for delivery in roughly a week. When deliverable inventory drains, premiums detach, spreads widen, and the screen price becomes the beginning of negotiation, not the end. Question for the comments. Do you think the next explosive move starts with investors piling in because of headlines, or with industrial buyers panicking because they can't source what they need? When major institutions float spring price targets around $135, don't treat it as promise or fantasy. Treat it as a signal that pressure is visible in professional models. But here's the catch. That assumes an orderly process with no shocks, no panic, and trusted delivery systems. Markets love to break the orderly assumption. Global demand runs around 1.2 billion ounces with supply closer to 1 billion ounces, leaving gaps of 200 plus million ounces annually. 5 consecutive deficit years isn't a cycle. The market is living off savings, and every year of deficit eats the savings further. Imagine a government that unloaded metal when prices were single digits, now facing a world where silver trades near triple digits. Replacing tens or hundreds of millions of ounces at these prices, when global annual mine output is barely over 1 billion ounces already spoken for by industry, creates competition that tightens the market further. If official buyers start negotiating long-term supply directly with miners, what happens to the open market float everyone else relies on? It shrinks. And when float shrinks, volatility rises. Solar panels, EVs, high-performance computing, AI hardware, 5G, grid modernization, these don't stop consuming silver because prices rise. The silver content is a small slice of total cost, so manufacturers keep buying even as price climbs. At what price does demand destruction actually begin? If you guess wrong, you learn the lesson the hard way. Price rises, premiums stay elevated, market clears at higher levels while supply tries to respond slowly. Inventories drain faster, delivery stress increases, sharp spikes and air pockets as participants scramble and exchanges tighten rules. Inventories drain faster, delivery stress increases, sharp spikes and air pockets as participants scramble and exchanges tighten rules. The difference is confidence, and confidence can crack quickly if physical availability keeps tightening. $92 is not the end, it's a signal. $135 is not the end, it's a stress marker. In disorderly scenarios, overshoots happen. But after an overshoot, the market doesn't necessarily return to the old world. If the market reprices because it realizes supply is structurally constrained, the baseline changes, the floor moves. Keep emotions out of it. Emotion is expensive. Stay informed. Join the WhatsApp channel for updates between uploads. Watch physical signals, premiums, delivery times, allocation language, inventory categories. Decide your plan before the market gets loud. Loud markets are the worst time to invent a plan. The bottom line, silver is scarce in the way that matters. Scarce in deliverable form, scarce at scale, scarce under time pressure. And scarcity under time pressure produces violent repricing. Don't get distracted by daily noise. Watch the buffers. Watch the flow. Watch the behavior of real buyers. Subscribe, join the WhatsApp channel, check the members-only update for the full deep dive, and drop your comment. Investor frenzy first or industrial panic first?